Global consumer price inflation remains high, though it's likely to have peaked across many advanced economies, including in the UK. So that's a warning that a notice from the bank that they do expect rates to come down. They're talking about wholesale gas prices here. But here's the key point, I think, here, Anna. UK domestic inflationary pressures have been firmer than expected. Both private sector regular pay growth and services PMI inflation have been notably higher than forecast in the November monetary policy report. The labour market remains tight by historical standards, although it started to loosen, and some survey indicators of wage growth have eased. So the bank making the point there, really it's these high levels of wage inflation that they're starting to see creeping through, which means that they had very little choice to raise interest rates right now. And again, I'm looking at the concluding remarks here around the policy statement. It's all about the fact that inflationary pressures here in the UK have been firmer than expected, and the MPC cognizant of the fact that CPI, the headline rate of inflation, currently more than 5 times higher than the bank's target rate. Here's the composition then. It was indeed Swati Dhingra and Silvano Tenreiro. They preferred to maintain interest rates, bank rate at 3.5%. So really no change in the balance between the doves and the hawks there on the Monetary Policy Committee. And here's the forward-looking bit that I think the market will be most interested in. The line here, looking further ahead, the MPC would adjust bank rate as necessary to return inflation to the 2% target sustainably in the medium term. And again, another kicker here, the extent to which domestic inflationary pressures ease will depend on the evolution of the economy, including the impact of the significant increases in bank rates so far. There were considerable uncertainties around the outlook. The MPC will continue to monitor closely indications of persistent inflationary pressures, including the tightness of labour market conditions and the behaviour of wage growth and services inflation. And here's the key line, I think, that everyone's going to hang their hat on today. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. So interest rates, bank rate at 4% right now. As I said just before we got that decision, the markets are pricing in right now bank rate to peak at around 4.8%. Well, the Monetary Policy Committee there in those minutes making very, very clear that there are likely to be further interest rate rises to come. We are not at what market participants yet refer to as the terminal rate. There will be further interest rate rises to come if these sort of levels of inflation remain persistent. Now, bear in mind that inflation expectations the expectations around inflation is that it will peak around mid-year and then start to come, or it's already peaked in October last year, but we expect it to start to tail off quite rapidly come the middle of the year as you reach annualised effects of the commodity price inflation increases that we saw last year.
OK, Ian King, thanks very much indeed for that rapid response to the Bank of England's decision to raise interest rates to 4%. That's their 10th consecutive rise. So let's get more reaction now. Joining me now is our economics and data editor, Ed Conway, who has been at a briefing at the Bank of England. So, Ed, what more can you tell us about the thinking behind this rate?
Yeah, the signal from the bank, OK, there's a few things going on here. They've raised interest rates by another ½ percentage point. More or less that was expected, so they're up to 4%. Let's not lose sight of the fact that that is a massive shift compared with where we were only a couple of years ago, down at 0.1%. So they're up a lot compared with a few years ago. Another ½ percentage point increase. But I think the significant thing here is there's been some subtle changes in the wording. So within the minutes, and that's what they kind of release alongside a kind of explanation of why they're taking this decision, there have been some changes where they are signalling effectively that we are very close to the peak in interest rates. And it's possible, according to this wording, that we might well be at the peak, although they leave kind of a bit of an open situation, so they could raise them by another maybe quarter percentage point, maybe a ½ percentage point. But the signal here is that we are getting very close to the peak in interest rates. 4% could maybe go up a little bit more, but we're getting close. And I think that's part of the key message here. There's a kind of Kremlinology when you look at these the minutes and try and work out what the central bank is trying to hint. Well, in this case, the hint is very much, last time around it was, there will be big increases yet to come. We're going to be forceful about inflation. This time around, it's signalling that we are getting close to the peak. Maybe there might be increases in interest rates after this if inflation surprises on the upside, so it's a bit higher than they expected. But that is a really interesting shift on where they were before. So definitely the signal is that we are, if not at the peak now, getting very close to the peak, according to the bank. And then the other thing that's worth noting is on top of the actual kind of monetary policy decisions, you've also got the forecast on the economy. So they are doing their quarterly opportunity to look at the state of the economy, say how it's doing, and the news there, well, it's hard to know whether you say it's good or bad. It's not as bad as it was last time around. So last time around they were talking about a very big fall in national income, down to kind of 1.5% in terms of the contraction this year. They've upgraded that, so it's now about 0.5%. That's partly down to the fact, or largely I should say, down to the fact that energy costs aren't quite so bad. Gas prices down quite a lot. Wholesale gas prices, energy costs mean that cost of living shock that we're already going through right now won't necessarily be quite as bad in the coming months as they previously thought. But even so, they are still talking about a technical recession. So the UK, according to the bank, still forecast to be in recession this year. What's a recession? It's 2 successive quarters where the economy is getting slightly smaller. What's the economy, by the way, in this case? It's national income. It's how much that's growing. But here's the thing. This, when you look at it on a chart, is basically the smallest recession that we've ever had in modern history. It's not really a recession. I mean, you know, like I say, it conforms to that arbitrary rule about what is a recession, but it's so small in terms of how far below the line. It's not really a recession. As I say, is that good news or bad news? It's good news that it's better than it was before, but in terms of the outlook, the UK is basically flatlining. We're flatlining, and we're flatlining not just for this year and for next year, according to their forecast, but we're flatlining in the future. And by 2026, according to their forecast, the size of the total economy will still be slightly below where it was before the pandemic. So if you can kind of take that into account, we're talking about 7 years of lost economic growth following the pandemic. So you've got that forecast side of things, you've got interest rates, which they have increased. But as I say, the hints, and they are subtle, but they are definitely the hints that they are trying to drop, are that we are, if not at the peak for interest rates at 4%, then we are getting close to that peak. That's the message from the bank.
And Ed, the IMF got a lot of headlines this week, didn't they, in this country, when they predicted that the UK would be the only major economy to plunge into recession this year. So is the Bank of England really in lockstep with the IMF? Are they in agreement on the prospects for the UK economy, would you say?
It's a good question, Anna, because, yeah, that was quite a controversial forecast for the International Monetary Fund. Not necessarily so much for what it says about the UK, but more the idea that all of the rest of the developed world is kind of moving up, whereas the UK is moving down. It'll be interesting to hear what the governor has to say about this. Obviously, we've got a press conference coming up, and we'll talk to the governor as well about precisely this. But when you look at those numbers within the bank's forecast, they don't forecast every single economy around the world, but they do give a kind of Eurozone forecast, for instance. That's quite a bit weaker than the IMF is forecasting, and the bank's forecast for the UK is a bit stronger than what the IMF is forecasting. So this would slightly kind of, I don't know if I'd go as far as saying contradict, but it would slightly kind of give a ever so slightly more subtle view of it. The UK is not in a very good place economically right now, certainly, but it's not suggesting that we are a massive outlier. But as I say, we'll have to hear from the governor about that, and indeed it'll be interesting to kind of get a sense on, you know, whether we are nearing this peak. As Ian was saying earlier, market's still talking about maybe rates getting up to kind of 4.5% or so in the next year or so before potentially coming down. Will he endorse that, or will he signal that we're kind of getting close to the peak? Either way, we are now, there's kind of light at the end of the tunnel with interest rates. We've had this period of 10 successive increases in interest rates up to 4%. And now the bank is signalling that maybe if there are going to be more increases, they might well be smaller. There may not be many of them. That's definitely a shift.
And we just looked at a graph there, Ed, showing the rise in interest rates starting in December 2021, when the base rate was just 0.1%, to today's figure of 4%. I mean, give us some context for the level that interest rates are at the moment, because some might say, well, look back 20 or so years ago, they were higher than this. Give us an idea of the context.
Yeah, it's a really good point, Anna, because actually when you look at the overall rate of interest rates, 4% is not very high. In fact, it's you know, going back to before the financial crisis, you look at 4% and you say that's kind of a normal level for interest rates, maybe a little bit below the kind of normal level. But here's what's happened since. And obviously, as you say, back in the 1970s and 1980s, you had double-digit interest rates getting up into the kind of teens. But what's different this time around is that across the country, people who have mortgages tend to have higher debts, okay? And so the amount that you end up having to pay each month in repayments is actually kind of comparable at interest rates being kind of 4-5% to where it was back in the 1970s and 1980s when interest rates, those nominal interest rates, the ones the bank set, were much higher. So the burden of interest rates and the burden for mortgage payers is pretty high right now. In fact, it's getting up to kind of those levels where before it caused some real pain, whether it's in the late 1980s or indeed in the kind of 1970s. So a really significant shift in interest rates, and it's the fact that they've come up from basically zero, in fact less than zero when you take into account the fact that the bank was also printing money electronically. Quantitative easing meant that money was flying into the economy. Now that's gone into reverse, so money is being pulled back at the same time as interest rates are going up, all of which helps explain why the UK is facing tough times at the moment. Not just interest rates, obviously, it's high inflation, it's the cost of living crisis, it's taxes going up, it's the fact that we're really sensitive to energy costs, it's Brexit on top of everything else. There's a lot going on, there's a cocktail of factors, but interest rates is making things tough for many households. So I think the fact, that we might now be getting closer to that peak and the bank is dropping hints about that, that's quite significant and it's worth us dwelling on.
Well, yes, and Ed, bear with us a moment because we have just got a reaction from the Chancellor, Jeremy Hunt, who's put out this statement saying inflation is a stealth tax that's the biggest threat to living standards in a generation. So we support the bank's action today so we succeed in halving inflation this year. That's one of Rishi Sunak's 5 pledges that he set out at the beginning of the year, of course. The Chancellor goes on to say, we will play our part by making sure that government decisions are in lockstep with the bank's approach, including by resisting the urge right now to fund additional spending or tax cuts through borrowing, which will only add fuel to the inflation fire and prolong the pain for everyone. So, Ed, I wonder what you make of the Chancellor's response to that, and also reminding us, perhaps, of the circumstances in which the Chancellor took over after Liz Truss's rather short-lived time in office.
It's more or less in line with what you would expect from the Chancellor. I mean, obviously, after what happened last year, the Treasury very keen to underline that they are not, they don't want to undermine the bank. They want to give the impression of kind of harmony within the kind of different authorities that deal with monetary policy here. However, the fact that inflation is coming down, that's something that the bank is mostly focused on. Remember, it's their job to try to keep inflation as close as possible to 2%. We're still way above that at the moment, still around that kind of 10% level. It is expected to have peaked now and it's coming down in the coming months, but still a long way from it. The bank's forecast is it gets down to around 2% by the end of the kind of forecast horizon, so that's in a couple of years' time, but still quite a long way for it to go. So that cost of living crisis, you know, we're all feeling it now. Unfortunately, those pressures on prices and on wages as well are likely to be quite high for quite some time.
OK, Ed, for the moment, thanks very much indeed. And you were talking about that news conference at 12:30. I'm sure you'll be in it, and there'll be lots of interesting questions and answers there. But for the moment, Ed, thanks very much indeed. So let's return to our panel to discuss the implications of the rise in the base rate of interest. Here with me are Riz Malik, a mortgage broker who is director of R3 Mortgages, Michael Clark from Turn to Us, which is a national poverty charity that offers support to people facing financial insecurity, and Vicky Price, Chief Economic Advisor at the Centre for Economics and Business Research and former joint head of the UK's Government Economic Service. So welcome back to you three. Thanks for hanging on while we got that interest rate decision. Vicky Price, to you first of all. No big surprise, this rise by 0.5% in the base rate?
No, we were saying before the announcement this was probably what was going to happen, and this is indeed what's happened. The interesting, evidence, if you like, coming out of whatever they have produced, which was read out by Ian originally, and then of course by Conway as well, when you were discussing it, is how you interpret whether they are hawkish for the future or whether this is the end. And they've obviously been looking at what the economy's been doing since as well, since they have very significantly upgraded their forecast for growth for the economy. And I think that's interesting in itself, because it suggests that they will be looking quite carefully, particularly at issues to do with unemployment. If the economy does better than they had anticipated, then obviously there's still going to be some pressure on the wages front. And that, of course, is something which everyone who is looking at monetary policy or thinking about interest rates will be watching very, very carefully, because if the tightness that we're seeing at present continues, then you may get that international inflation, yes, coming down, but domestic inflation perhaps staying with us for considerably longer. So that's the decision which I think they're going to have to be making over the next few months. But for the moment, I think it's a sensible increase, and the markets may well decide that we're not going to see anything very much more from here on.
OK, I'm going to ask you all just to hold fire just for a moment, because we have a little bit of breaking news, but I do want to get everyone's reaction to this news about interest rates. But first, we've got some reaction from the Prime Minister's official spokesman to the story we've been telling you about British Gas, first broken in the Times newspaper today, who reported that debt collectors were breaking into vulnerable customers' home to fit prepayment meters. Well, the Prime Minister's spokesperson has just said that reports today are deeply shocking and concerning. Vulnerable families should not be treated so poorly. British Gas has rightly now suspended this practice, as the Energy Minister, Graham Stewart, is due to meet with British Gas this afternoon at 3:30. And the spokesperson confirmed that that meeting was in response to the reports today, as opposed to being pre-planned. So the Prime Minister's spokesperson there confirming that the Energy Minister would be meeting British Gas this afternoon at 3:30 to discuss this news, first broken by the Times newspaper, about debt collectors entering vulnerable customers' homes. So let's rejoin our panel, and thanks for bearing with us once again. Riz Malik, you're a mortgage broker, so what do you make of the decision today, and how are the customers approaching you going to feel about the fact that interest rates have gone up for the 10th consecutive time?
It's just going to create more uncertainty. We've started to have rates calm down after the fiasco of the last quarter of last year. And like I said, in the last couple of weeks, we've started seeing lenders bring down rates. Anything where there's sentiment for rates to go upwards from there onwards doesn't necessarily help, even though fixed rates aren't based on necessarily what the rates are today. They're based on swap rates in the future. One thing that I would say is that where there is this constant change, it's very important to pull out your mortgage paperwork, or if your deal's coming to an end, to review what you have to make sure that you're on the best possible deal or term for yourself. So this is a great time to have that conversation, review what you have, even if you've put in a mortgage application a month, 2 months before. With the price competition the last couple of weeks, it may still be worth reviewing that. Even the same lender might have brought down the product and the pricing. So it's very important to review your mortgage at the moment. Do I think the rate rise should have been 0.5%? No, because by that logic, until inflation comes down to 2%, we should be having rate rises. Prior to today, the Bank of England itself was forecasting inflation to somewhat halve by Q4 of this year and drop down to under 2% by the year thereafter. So although I agree with what Ed was saying about the rates, we might be nearing the peak of the rate rises, and that's what people are considering when they're thinking of locking themselves in to long-term mortgage products.
Well, yes, and Michael Clark, you help people who get into financial difficulty. Would you agree with that advice? What would you say to anyone who hears the news that interest rates are going up and are concerned about paying their mortgage?
I'd agree with that. I'd also say go and check what benefits you might be entitled to. A lot of people do not claim all the benefits or don't realise that their incomes have dropped to the point where they might actually be entitled to something. So they should do a benefits calculation. They could find out if they could get something. I do worry about the 14.5 million people already below the poverty line, who are being kept there by a combination of low wages, by increasing costs of living. And what the Chancellor has said does make me worry that this might be used as further reasons for keeping those wages artificially depressed.
And Michael Clark, I raised this point with Ed Conway, that there will be some people who will have lived through the 70s and 80s who will say, but interest rates were much higher then. 4% doesn't feel that high compared to those times. And he made the point that people have larger debts now on their houses. Would you agree that that's one of the main issues here?
It's an issue, but I'd also say, and I will confess I did live through those times in the 70s and 80s, that in the 80s, people proportionately had better benefits than they do these days. Proportionately, they are a lot lower than they would have been then. There's a lot less margin of error.
And Vicky Price, looking more broadly as well, we haven't just had this interest rate decision today from the Bank of England. They're also setting out their forecast for the economy, aren't they, in their quarterly report. So what have we learnt so far? We'll get more details, of course, when we hear that news conference. But what have you learnt to date?
What we've learned is that as far as the Bank of England, of course, is concerned, and their own forecast is that we're going to see a shallower recession than would otherwise have been the case. I think if you looked at what they were forecasting before, we were talking about a drop maybe of 1.5%, 1.4% in GDP through 2023. Well, now the fall is likely to be a lot less. So it is, in fact, as you were asking, Ed Conway, it's very similar to the International Monetary Fund's forecast of a drop of 0.5%, which is bearable, I suppose you could say, but within that, people will be losing out quite significantly. Real incomes are being affected, wages are not rising anything like in line with inflation, except in some sectors like the financial sector and professional services, maybe bits of manufacturing as well. But overall, we're seeing people losing out quite significantly. And this interest rate increase, of course, is going to make things worse. And as was mentioned also by Ed Conway, tax increases are affecting everyone too. So we're not out of the woods yet. And there is a question mark about the interest rate increases overall, which is that given the international fall in prices that we talked about earlier, one wonders what those interest rate increases are actually achieving, except just making life much more difficult for many people rather than necessarily bringing down inflation quickly. That is coming down mainly because of falls in gas, electricity, oil and food prices, which will eventually come through to the consumer here as well, rather than anything significantly to do with interest rate increases.
Interesting. And Riz Malik, I can see you nodding your head there. What would you say the impact of all of this is having more generally on the housing market?
Well, on the housing market itself, obviously, it's going to increase the options that are available to people and potentially make the cost of borrowing more expensive, again, depending on which products that you're looking at. But like I said before, I think that some of the lenders have baked part of this increase already into their mortgage products. I think those who want to move and they have got the intention to do so will still be doing so. We haven't really seen the big drops that we were expecting or forecasting in property prices. I think those might come towards the middle part of the year. But yeah, I completely agree with that last point. I don't think they're necessarily, in terms of achieving their goal, I don't think it helps. But the rates are the rates at the end of the day, and those are what we have to work with.
And Michael Clark, we touched on this a little bit before the decision, the fact that when you get an interest rate rise, obviously anyone who's got a mortgage will be worrying about their payments, but there will be savers who perhaps have paid off their mortgage or rent, who will be hoping that their interest rates will go up on their savings. Are you optimistic that will happen swiftly? And what kind of difference could that make to people who are concerned about their money?
If you have savings, then obviously it will have a positive impact on you. It gives you something that you can look forward to. If you don't have savings, and in our constituency that would be a lot of people, then it won't help you very much.
OK, and a last thought, Vicky, on the economy and the outlook and where we might head from here. Do you think we're going to get many more interest rate rises in the months ahead?
I think there may be one more. I don't think there's going to be an awful lot after that, because indeed inflation has probably peaked. Yes, we're going to have a little bit of an issue in April when prices for electricity for households go up again. And also, of course, we have a lot of the withdrawal of support to businesses as well on the energy side. So there could be a little bit of an uptick then. But overall, I think we'll be seeing inflation come down quite significantly. And that would be good news in terms of interest rate rises for the future. But the economy is not going to do anything very much at all. And in the longer term, I think there are serious worries that we've lost so much output because of COVID and the energy crisis as well, and haven't quite made it up yet. Okay. And that's going to drag the economy down for a while.
And really interesting to hear what the Bank of England themselves say about this in their news conference, which is in about 3 minutes' time. So we need to wrap things up, but we really appreciate your thoughts. Vicky Price, Michael Clark and Riz Malik, thank you all very much indeed for your reactions. Before that news conference, let's just bring you some breaking news about British Steel and the Business Secretary, Grant Shapps. We can bring in our City editor, Mark Kleiman. So, Mark, what can you tell us?
Yes, Anna. Grant Shapps, the business secretary, has written to the chief executive of British Steel's owner, Jingyi Group, a Chinese-based conglomerate, to accuse the company of making an unhelpful move by announcing plans for hundreds of redundancies during talks with the government about a separate taxpayer funding package. Now, we've been covering this story over recent weeks. Jingyi is in discussions with government ministers about securing £300 million of taxpayer funding. But that money is partly conditional on the company not making any redundancies for the next 6 months, and also on guaranteeing a proportion of its workforce will have their jobs preserved for the next 10 years. So the timing of this move by British Steel's Chinese parent is very odd, to say the least. And I understand that Mr Shapps has sent a strongly worded letter to British Steel's parent company. This morning, for the first time, British Steel confirmed that it is indeed planning to make redundancies. It said in a statement that it was reluctantly having to consider cost-cutting in light of the global recession and increased costs. There's no mention in the British Steel statement about the number of jobs that it is planning to cut, but we understand that it is about 800. So we should get more on this in terms of reaction from both the company and trade unions over the next couple of days, I would expect, Anna. But these plans are unfolding. There will be significant redundancies at British Steel in the weeks ahead.
OK, Mark, thanks very much indeed for that. Well, just to remind you that we are waiting for that Bank of England news conference to start. It's due in about a minute's time. As soon as everybody gets in the room and is ready, we will cross back there live to get the thinking behind the rise in interest rates at midday today, and also the Bank of England's outlook for the economy. But while we wait for that, let's just return to that breaking news and the Prime Minister responding to reports about British Gas debt collectors forcing their way into customers' homes to install prepayment meters. Rishi Sunak's spokesperson says reports today are deeply shocking and concerning. Vulnerable families should not be treated so poorly. British Gas has rightly now suspended this practice as the Energy Minister, Graham Stewart, is due to meet with British Gas this afternoon at 3:30. An inquiry has now been launched by the energy watchdog Ofgem. So that was the Prime Minister's spokesperson, and the story was first reported by The Times, which carried out an undercover investigation. Footage showed debt collectors breaking into vulnerable people's homes to forcibly fit prepayment meters.
Hello, it's British Gas, your gas supplier. We're here with a court warrant. Can you please open the door? Otherwise, there are lots of people open it for you. This is the exciting bit. I love this bit.
Which bit?
This bit. I love this bit.
Well, this morning, the Chief Executive of Centrica, Chris O'Shea, spoke to our business presenter, Ian King, who asked him when he was first made aware